This is our first episode of the year and it's packed with valuable insights. The December 2024 property market data has just been released, showing a widespread downturn across Australia's housing market. A few cities are still seeing an uptick, but all signs point to a weakening trend. Does this mean the crash cycle has arrived? In 2025, there will be major policy changes. Considering both domestic and international environments and shifting dynamics, how should we begin investing in Australian real estate? Can the old investment concepts still apply? This year, there are only two paths to making money in Australia's property market. If you watch this episode to the end, you'll find 2025's investment journey much easier. Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Let's start by quickly reviewing the December 2024 trend in the Australian housing market. Understanding this foundation will give you a head start when the 2025 market gets underway in February. In December, the nationwide housing market index declined by 0.1%. This was the first drop after 22 consecutive months of rising Australian property prices, which could very well signal the start of a downward cycle. However, December and January tend to be the low season for real estate. December marks the end of the previous year, and January signals the start of a new one. I usually group these 2 months together. To see a clearer trend, we'll have to wait for the data from February and March. Sydney's housing market ended its 20-month streak of price growth back in October, starting a downturn. The decline sped up in November, and in December, it dropped even faster at 0.6% for the month. According to Aus Property Strategy's investment system, any monthly fluctuation within plus and minus 0.5% is considered a flat period, nothing too alarming. But Sydney's 0.6% drop in December has crossed our warning threshold, and the pace of decline is picking up. Whether this will become a sustained trend or bounce back quickly depends on many market factors in 2025, which I'll discuss in a moment. In December, Melbourne's housing market fell by 0.7%, accelerating from November's 0.4% decline. Over the past 17 months, Melbourne's monthly price changes have stayed within plus and minus 0.5%, essentially in a flat range. Every month's decline was under 0.5%, forming a prolonged, gradual downturn rarely seen in Melbourne's history. This gave owner-occupiers enough time and space to shop around and negotiate, and also allowed investors to shift their mindset from fleeing Melbourne to reconsidering it. But now that Melbourne's December drop has surpassed our warning threshold, we need to watch closely. Although the markets in both Sydney and Melbourne are heading down, that doesn't mean every suburb in New South Wales and Victoria is declining. When we conduct Aus Property Strategy's Vision Bias Agency services, we still find quite a few areas in New South Wales and Victoria with relatively affordable prices, steady growth potentials, and high rental yields. Brisbane has risen for 21 months, with a 0.5% increase in December, entering what we consider a flat period for the first time in 2 years. Adelaide also climbed for 21 months, up 0.6% in December, though it's starting to lose momentum more noticeably. Meanwhile, Perth has now seen 22 months of growth at 0.7%. These three mid-sized cities have enjoyed a significant boom in the housing market over the past 2 years. A lot of people ask, so where should I buy? Well, that depends on your investment preferences. Number one, if you're someone who needs to see prices go up the moment you buy, then it's simple, go where prices are currently rising. Number two, if you feel you must always hunt for bargains and think something's missing if you don't, then Sydney and Melbourne might be best over the next 12 months because the market is sluggish and prices are relatively lower. Number three, if you're focused on long-term, 10 to 15 years appreciation and aren't too concerned about short-term ups and downs, your main goal being to ride overall growth, keep earning over time, plan your taxes well, and allocate assets properly to reach your financial targets, then which large or mid-sized city you choose won't make much difference. What matters most is that your portfolio is structured correctly and aligns with your plan. As for Australia's other three smaller cities, Hobart, Darwin, and Canberra, they've been in the flat phase for 2 years. I call it a volatile flat period. Each month's swings stay within plus and minus 0.5%, but it's not clear whether it'll be plus or minus 0.5%. There's no clear trend at all. For those of you watching Aus Property Strategy for the first time, let me add this. When we talk about the overall market or the so-called market trend, we're measuring the average price changes, which don't apply to every individual property. Australia's broader market statistics don't represent every single city's performance, and Sydney's average doesn't reflect the reality of every suburb or property. The big picture gives us only a general sense of direction. Individual properties must be analyzed on a case-by-case basis. One of Oz Property Strategy's investment principles is, even in a soaring market, you can still stumble. And even in a crashing market, you can still find a gem. If you really want to see the trend, the best way is to look at the rolling 90-day chart, because stretching the time frame to a quarter will smooth out the ups and downs, making the trend clearer. Looking at the chart, it's quite obvious that the mid-sized cities are still in the upward phase, though their rate of growth is slowing. Sydney and Melbourne, on the other hand, have entered a downturn. However, there may be some shifts in February and March that could ease the trend or even spark a possible reversal in 2025. Those 4 little green circles on the chart mark the 4 points in the past 3 years when Oz Property Strategy predicted the overall market direction, and as it turns out, all of them were accurate. In December, Australia's housing market continued rental patterns seen in recent months. Average rents across all cities went up, whether for houses or apartments. However, only Hobart saw a faster uptick in rents, while the other cities saw slower increases. Turning to rental yields, Darwin still leads the nation at 6.7%, Sydney is the lowest at 3%, while the national average is 3.7%. Rental yield, also known as the rent-to-price ratio, is simply the annual total rent divided by the property price before expenses, so technically it's gross yield. The only good news for the month is that inflation has come down. Data released by the ABS on the 8th of January shows Australia's trimmed mean CPI for November at 3.2%, a noticeable drop from 3.5% in October. That eases concerns about the rebound in inflation. However, the unemployment rate remains at 4%. If unemployment were to rise a bit, the RBA would have more reason to cut rates. On 11th of December, the RBA decided to hold the rates, and seeing the latest data, I'm guessing a February rate cut is now out of the question. All hopes may now rest on the meetings scheduled for the 1st of April or 20th of May. Starting in 2025, there will be major shifts in Australia's property market, economy, politics, and international environment. It's definitely not going to be a quiet year. Describing it as turbulent or unsettled wouldn't be an exaggeration. As of now, the Reserve Bank of Australia still hasn't begun cutting interest rates, while some other countries have already paused. After reviewing Australia's recent inflation and employment figures, it's safe to say we can rule out any rate cut before April. The RBA's actions will be a key point to watch in the 2025 housing market. A second point people often overlook is the role of the Australian Prudential Regulation Authority, or the so-called APRA. They seldom appear in the news, but when they do, it's usually a big deal. One of APRA's tasks is to control lending risks in the banking sector. I read APRA's November meeting minutes, which show that Australian households already carry a lot of debt. If the RBA cuts rates and drives banks to lend more, APRA might respond by tightening regulations, such as restricting high LVR loans or high DTI loans. In other words, an RBA rate cut would boost the market, but tightening lending policies from APRA would pull it back. The third thing to watch in 2025 is Australia's federal election, likely to wrap up before the end of May. Over the past 3 years, the federal Labor government has created numerous problems for Australia, something I've mentioned in previous episodes. On the international front, there are quite a few uncertainties. One is what Trump will do after taking office in late January, especially regarding tariffs. How will that impact the global economy, the flow of international capital, exchange rates, and exports? And most importantly, to what extent? Right now, it's hard to say. Things in China are also quite unusual at the moment, especially in the stock and housing markets, though plenty of channels have already covered that. Perhaps you've noticed that starting from January the 1st, 2025, China began a new round of conscription. This year, the publicity has been especially vigorous, and all men over 18 are required to register. Once they sign up, if the country calls, who knows if they can refuse? Registration isn't forced per se, but not registering will affect your college admission and job prospects. Well, doesn't everything feel more tense these days? When it comes to real estate investment in 2025, the first thing you need to do is distinguish between active investing and passive investing. Active investing basically means getting your hands dirty, such as flipping properties for quick profits, renovating old houses, building extensions, or splitting one title into multiple. These options are suitable for those who have the time, the mental bandwidth, and some financial means, and are willing to put in the work. Essentially, you're taking on a job or starting a business. This group makes up around 1% of property investors. The other 99% are passive investors using buy and hold strategy. Here at O's Property Strategy, we focus solely on passive investing. We're all busy enough as it is. Everyone's got their own jobs to do. Who has the energy for all that hassle? It's better to just buy, hold, enjoy passive capital growth and cash flow. If you want to take passive investing to the next level, there are 7 steps. Number 1, set your wealth goals. Decide what results you want in the coming years through property investment. How many properties, how much cash flow, and whether you aim for financial freedom, retirement freedom, and travel freedom. Number 2, conduct a financial health check. Take out a pen and paper and calculate exactly how much cash you have, the remaining mortgages on each property, each interest rate, your monthly repayments, fees, whether you have car loans or credit card debt, your current earning ability, and your potential for career advancement or salary increases. Only with a clear picture of your situation can you develop a workable strategy. Number 3, create an investment plan. How much money will you spend on a property? Under whose name? What loan-to-value ratio will you aim for? Which location and type of property will you buy? And when? Develop a 10-year plan. Number 4, plan your financing. Having an investment plan is not enough. You also need to check whether you can actually qualify for the mortgage. Number 5, plan your taxes. After you make money, how can you legally minimize your taxes? And once you know these strategies, how can you backtrack and figure out the best tax structure for yourself? Number 6, plan for wealth transfer. After you've acquired multiple properties and made money, how will you distribute those profits? In my membership group, there are people who drew up their wills at 35, while others are 79 and still haven't figured out their plans for inheritance. Which one would you want to be? Number 7, portfolio management. Every year, you need to review your plan and the actual performance of your property investments, making timely adjustments as needed. Only by following these 7 steps can you take real estate investing to the next level. Here at O's Property Strategy, that's exactly how our Vision membership operates. In 2025, you can invest in property using 2 main strategies. Number 1, high capital growth strategy. This is suited to those who are just starting out. Even if the property has a slight negative cash flow, as long as it appreciates quickly and doesn't affect your day-to-day life, you can buy and hold. A few years later, you can cash out the increased equity and purchase your next property, allowing you to grow your portfolio rapidly through leverage. In Australia, properties that generally yield strong long-term capital growth are standalone houses. Apartments and townhouses may also appreciate in value, but usually at a much slower pace. Number 2, high cash flow strategy. Once you own several properties or you are already close to being able to retire at any moment, it's time to shift to high cash flow properties to accumulate passive income. After you reach the point where you can retire anytime you want, you can sell a few properties and pay off the loans, freeing yourself from debt while enjoying high passive cash flow, achieving true financial freedom. High cash flow properties include those suitable for short-term rentals like houses with multiple rooms, properties in smaller or regional towns, or even commercial properties. I want to give you a crucial piece of advice. It's the underlying logic for Australian real estate investing. Always use finance. The reasoning is straightforward. If you pay all cash for property priced at, say, $1 million, you need about $50,000 in initial buying costs, plus you still pay council rates, water rates, strata fees if any, property management fees, land taxes, and so forth each year. Suppose the gross rental yield is 3.8%, then the net yield might only be 2.8%. Yet $1 million in the bank can earn you 5% a year without any transaction or holding costs. Or if you invest in the US stock market, the average annual return can be around 10%, with very low transaction fees and almost no holding cost. By using a mortgage, you amplify the net return on your own capital. Assuming an average 7% annual growth for a house with an 80% LVR, your cash-on-cash return can reach around 27%. That's the power of leverage. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.